Hello and welcome everybody. This is Dr. Richard Smith and we are back for day 2 of the Financial Cycles Summit. And with me to kick off day 2 is Jeff Hirsch. Jeff,
how are you, sir?
Thanks so much for joining us.
Honored to be part of this whole rebirth.
Well, we're honored to have you and the legacy of the Hirsch family to help, kick off this new cycle, really, in the history of the foundation. It's got its own cycles, right?
And at a pretty opportune time in the reset of the market with this pandemic quarantine thing, that might end up making things a little different. It might be
like we had the sense that we just couldn't wait, and this was even before COVID came. It was just, it's 90 years since the Depression, and Dewey that was his impetus for getting interested in cycles. What the heck caused the 1929 stock market crash and ensuing depression? That's how he got interested in cycles, and now it's 90 years later, and then lo and behold, events unfold that are echo, what happened in 1929, right? So yeah, so
little echo of the 60s as well.
Little echo of the 60s as well. That's right. That's getting on the 50-year cycle, right?
Well, the stuff out in the streets and what's going on publicly with the whole social movement, which I think is important as well for the end of the big nifty 50 market there in the end of the 60s. And there's all kind of, these things tend to happen around each other. These big moments in history.
Well, we are excited to have you today. We had a great day yesterday with Larry Williams and Sherman McClellan. That's 100 years of market wisdom there between the two of them. And they both gave great presentations. And look, everybody, we're drinking from the fire hose this week, right? We're not here, delivering a pat set of answers. We're sharing. We're going to go more into depth on these presentations in the coming weeks, but this week we're just drinking from the fire hose and having conversations with leaders in the cycles world like yourself, Jeff. For anybody that doesn't know Jeff, he's the editor of the Stock Traders Almanac. I mean, just one of the classics of the cycles world. You have your own newsletter as well, right, Jeff?
We do.
There it is, the Stock Traders Almanac. You can buy it on Amazon, but better to get it from Jeff directly and subscribe to his newsletter, which is an incredible resource. And I think you get a free version of the Almanac when you subscribe to that, right? StockTradersAlmanac.com.
Sure is. I'll show a little slide so people know what it is, just quickly.
Cool. And Jeff, you also wrote the little book of stock market cycles, which I have right on my desk over here.
That's the.
Oh no, that was the wrong one. Here it is.
All right, that's all right. There's a good series.
It is. So, and I know you're regularly on CNBC and Yahoo Finance, and so really appreciate you joining us today.
Happy to be here.
All right, shall we get into it?
Let's do it.
All right, why don't you go ahead and share your screen? And I'm going to turn off my camera, I think, so we don't distract anybody with our visages. Why don't we just let's focus on the slides, and I'll jump in with some questions, and then we will kind of get together for some Q&A afterwards.
Got it.
All right, take it away.
All right. There's the video off. All right, thanks everybody for joining us today. Going to try to give you a nice overview of the election cycle and also the best 6 months, and a little bit of what we do in the newsletter. And just wanted everyone to know who may know our history. My father, Yale Hirsch, who started this whole thing back in the year I was born in '66, is alive and well at a nursing home in Rockledge, New Jersey. He is 96 and a half. Saw him before we took off for a little vacation. And he kind of knows where the market's at, but not quite as sharp as he once was back in the day. So let's get into it. And if anybody wants the slides, they can contact me or go to our website, as Richard said, StockTradersAlmanac.com. And if you have any questions or if anything seems unclear, try to, you can interrupt me if need be, or we'll just get into some Q&A at the end. So just a word from the lawyers. This is for informational purposes only. Past performance does not guarantee future results. Not offer to buy or sell any securities, etc. So forth. Do your own due diligence. Consult with your advisors, and etc. So 54 years of the street, give you an idea of some of the things Richard mentioned. The stock market cycles book, our 2020 almanac. The 2021 is being put together now and will be out before Thanksgiving, usually, if all the powers that be function properly, especially this time that we're in. Yale's old book, Don't Sell Stocks on Monday. Great title. In the middle there, always was able to turn a phrase to my father. And the first 68 book, just for posterity, came out in the fall of 67. And some of the places I get to appear on and get quoted in, very proud of that. And then the super boom cycle, which I'm not going to really cover today because it's a different kind of thing. It's something that Yale discovered back in 76 after the 74 low, that markets have 500% or more moves after war ends, and that was after the Vietnam War. And we made a similar forecast in 2010 after we got through the 09 bottom for a 500% move off of that by the year 2025. Getting quite close to that, a little bit ahead of schedule for Dow 30 and 820, but that's sort of a long-term secular market cycle that we won't really cover too much today. But
when did you publish that book, Jeff?
That book came out in 2011. We first put it in the
Pretty good.
Almanac 2010. We made the forecast initially in May 2010 in the newsletter. And we were interestingly working on an update for it when the COVID thing hit and the market fell. So we focused on some of those things instead of updating the big forecast. But we'll get back to that when the dust settles a little bit. But yeah, 2010, we made that forecast.
Definitely let us know when you want to talk about that.
Oh, sure. No, and it's one of the greatest charts out there. And that could be a whole discussion. Something Yale drew that he used to put up on the transparencies on the overhead projectors when he made presentations of the day, that we have to keep an old version of Excel around to draw that chart on a different CPU, because the new versions of Excel won't let you draw it the same way. So, but maybe you can help us with some software there, Doctor.
You know, I actually built a charting program that I left behind at my former company, but I've had the same problem. I talked to the McClellans. You know, they're still using Lotus 1, 2, 3 for some of their charts for the exact same reason. So there's definitely a need for a great charting program for people who love great charts.
For log scales of things that go back 100 years.
Yeah, exactly. You know, that's important stuff.
For sure. So our basic philosophy sort of comes off of the old famous George Santayana quote, the Spanish-American philosopher, that said, "Those who fail to remember the past are condemned to repeat it." We tend to think that those who study market history are bound to profit from it. But another great cycle guy, our buddy Sam Stovall, who's now at CFRA, I think that's how the letters go, likes to remind us, as did Twain, you know, history rhymes, but here, use history as a guide, not as gospel. Sort of. Again, I know you were telling me that my old buddy Larry Williams was being candid about the reality of cycles, and that they're not always perfect. So again, these things rhyme, and in the fund that we run based upon the almanac, you're looking for different bullish and bearish days of the month. Sometimes they were off a day or so because you're looking at historical averages and patterns that aren't necessarily the same at every given day. So you gotta sort of time it a little bit and feel it as well. A bit of an art and science combination. So we've been at this for over 50 years, my whole life pretty much, or not pretty much, entirely. We researching everything we can come up with. Please send us your thoughts or ideas. We'll have a look and see if it's something we can work with. We publish those findings in the almanac annually, in our newsletter, monthly and weekly. And we layer a bunch of things on top of cycles and patterns, fundamentals and technicals. I look at internals and sentiment, put call ratios, the one that's in Barron's, advanced declines, new highs and lows. We run some of those tables that come right out of the back of the almanac in our newsletter outlook, looking at all of the different statistics. Of course, monetary and government policy, current trends in the economy, along some of the sectors that we think are important going forward, and of course our roots and cycles, seasonality, and recurring patterns. So just a little offer special for people who are paying attention here and joining us here for this new birth of the Financial Cycle Summit. Just an offer for the Almanac, and I'll give you both books, the current one, which is about half a year old, and then the 21. You save a bunch of money, $150 for 1 year, $250 for 2 years. Here's a couple of codes. You can email, call me for them, and all our subscriptions come with a free Almanac. And basically these presentations that I make, and I do make them in different venues, is how to use the Almanac and what we do in our newsletter, which is the newsletter was putting the Almanac to use throughout the year and month and every week. So that's what we're looking at there.
Great.
The major cycles, war and peace in the markets, that's the subject. And the secular bull and bear markets, that's the subject of that super boom cycle that I mentioned. Today, I'll focus on the 4-year presidential cycle and the seasonal cycles, mostly the best and worst 6 months, and sectors and commodities. But there's a couple of things that you'll see quarterly, monthly, and weekly, and even daily and intraday. So one of the things I started out doing, creating the Almanac and working for my father, was doing the calculations on the daily and intraday and monthly patterns using the Barron's Market Lab pages with this short little ruler that I have. I still have to this day, and a red pen. And you go down that little box, and I would underline half-hour upticks. And then, of course, close to open, you'd have to underline the open from the previous close and add them up and tabulate them using an adding machine and graph paper. This was in the 80s when I was working, part-time for him as a kid. And then when I started full-time, I guess it was 92, I finally converted it to DOS, Excel for DOS. And then 3.1 Windows was the next big move. And now my business partner and compatriot, Christopher Mistel, has created a piece of software that we use. We call it C-Web for Chris, but it's basically we can query it, and whatever things that come up that we want to look at, he'll write some code. Like we're looking at and everyone wants to know what happens when a Republican president gets reelected in a post-election year with the Democratic House and a Republican Congress, and well, there's 2 instances of that, so it doesn't really matter, but we could take those 2 years and map an average chart of them, or if it's 10 or 15, whatever it is. So different things like that enable us to look at things many different ways and examine many cycles. So I think this quote from old Tricky Dick Nixon, one of my early memories as a kid was the whole Watergate scandal. I was about 7 years old when it all went down. So that was one of my early current event memories. But this really sums up the 4-year cycle, and this is in his book, 6 Crises. He says Dr. Burns, who was the Fed chair back then, had a not so illustrious career at the Fed, if memory serves. And his conclusion, though, was that unless some decisive action was taken, and taken soon, we were headed for an economic dip, which would hit its low point in October, just before the election. So here we're looking at 2 of our most important cycles mentioned in a quote from a president who's quoting his economic advisor and Fed chair about seasonality in October, seasonal cycles, and election cycles, all wrapped in one pregnant little phrase from Richard Nixon. So that brings us to the basic chart of the 4-year cycle. NASDAQ, of course, on the right, a much more impressive movement, much more magnitude here. But the standout in this chart, and we've looked at this pattern going back to 1833 with the numbers that are in the Cowles Commission book, which I still have on my shelf. But you can see that the 3rd year, and this is what creates the 4-year cycle, is the strongest. This is the year before the election where the president primes the pump, does everything they can in their power to get the economy firing on all pistons and the stock market going up, so that everyone's very happy and their wallets are and bank accounts and portfolios are doing well when they go to the booths the following year. And this is what we saw last year. We've seen election years become a bit of a battleground. This year has proven to be along those lines, even though it was a major exogenous occurrence that really caused the problem here. Nothing systemic. And most of the market's gains have been made in this third year, and we saw it again last year, and it just continues to prove the importance of that third year. Post-election years, midterm years, but a little different. We have seen a lot of midterm lows. You see NASDAQ here. Even December 2018, when we had that sell-off, we had a midterm election year low. It wasn't an official bear market, even using the Ned Davis research rules, which I do. But still, again, this is the pattern of the 4-year cycle that is what's worked for many years. You'll see, as I've shown here in the post-election year syndrome, we've had all these major bear markets occur. The major wars have begun in post-election years when new presidents there. We had after 29, there was 4 straight down years. The 4-year cycle was off, and 33 was up huge. And then we also had the secular bull market of the late 80s and 90s, which basically had the 4-year cycle on hold because everything was just screaming up. And here in the 21st century, we had a couple of down years in 01 and 05. 09 was that huge bear market bottom, up 59% off the 2009 low. And 2017, another banner year for the market. Not every post-election year is horrible, but Dow is up 25%. I think NASDAQ is up about 19. So generally, what we're looking at post-election years are, either a second-term president not needing to be so bold and do things to get reelected, or a newbie that is going to be tested by the markets and the other countries around the world. Looking at the political alignment patterns here, and I know there's a bunch of different bars here, but people want to know what to expect from the stock market with who's in the White House. But what's really more important is who controls Congress. We know Republican ideology is a bit more conservative, a little tighter with the money. Democratic ideology is a little bit more, interested in spending, and new programs. So what we found to be the best combination is Republican Congresses. You can see right here in the 4th bar, up 14.6%, with Democratic presidents up 10.1%. So you've got a sort of perhaps progressive-minded president working with a fiscally conservative Congress, creating this 16.4% average gain. This does include some of the Clinton years, and where things were pretty, screaming up in the late 90s. So depending upon what happens, if Congress swings and Trump wins, you're going to have a potential contentious situation. And if the Democrats sweep everything, which is kind of one of the other possibilities out there, though it's not really, the polls I don't think have been very indicative. You're still looking at an average, about 7.4%. I don't know. My assessment would be that if Trump gets reelected, I think the Democrats could take one or more of the houses. If a Democrat gets elected, I think they would sweep both branches. That's just a little opinion there, based upon my experience and just.
And so, Jeff, this is the average annual gain over the 4 years of that, or just
over any year, because you have a midterm election in
got
2 years. So whatever, all years where there was Democratic presidents, 10.1. All years where the Republican Congresses, 14.6. All years where you had a Democratic president and a Republican Congress fully controlled, 16.4%. So it's not that's the average of all years that had those political combinations.
Got it.
All right. The midterm year sweet spot, the bottom picker's paradise. On one of the pages, in the almanac. You see in October, 12 of the last 22 bear markets bottom in October, a lot of those in midterm years. And I've tried to highlight here this in the black reverse box, this 3/4 sweet spot of the 4-year cycle. You see in the orange, Q2 and Q4, the midterm year, that's ending in June and September, the weak period, the worst 6 months, tends to be the weaker months, negative in Q2 and Q3 for NASDAQ, and pretty much no gains in Q3 for Dow and S&P in the midterm year. And then you get these big swings in the fourth quarter of the midterm year, and the first 2 quarters of the pre-election year, for an average gain of about 19% for the Dow, 20% for the S&P, and 29, almost 30% for NASDAQ in that 3/4 combo. Whereas that sort of bottom pickers area there, Q2 and Q3 of the midterm year, down about 1.5% or even 5% for the NASDAQ. So this cycle is a combination of the quarterly patterns, which the financial world runs on with quarterly statements and quarterly expirations of index futures and index options, and which we just had last week. What I still call triple witching. I had a discussion with my trader friend about single stock futures. He says people get amused when I sort of pin single stock futures. I'm not sure. Have you heard of anyone trading single stock futures?
Not for a long time.
And they never trade them a lot. So this whole quad witching thing I find to be amusing, because we've been calling it triple witching for years, and I only say it because people get upset that there is a single stock future. But that's what helps create this quarterly pattern, in addition to the 4-year cycle where
I really appreciate about your work, Jeff, is like a lot of people, they follow cycles, but they don't really know why the cycles exist, right? But you're pretty clear about the cycles that you follow and why you think they exist.
Since I've been working here full time with the Hirsch organization for 30 years now, it's been one of the things I've had to explain. I know there was a lot of and had to figure out. Yeah. And I did a lot of that with Yale, and I've done a lot of with Chris now. But you have to go looking for the reasons, and admittedly, sometimes they're not immediately obvious. But having been asked it so many times and having looked at it, some of them are clear. Expirations and triple witching is a clear movement. And a lot of these things Yale was talking about, especially, how the government manipulates the economy to stay in power, which is that priming the pump. Sometimes we call it the quadrennial quadrille for more alliteration fun. But, we try to combine the things. We try to look for correlation.
Yesterday, Larry was talking about how the kind of, the sell in May and go away thing shifted around 1960. It used to be kind of buy in May before 1960, and then it was kind of sell in May post 1960. Is that?
I have a slide to show that to you myself, and it's one of the reasons Larry and I get along so well is I'm going to get there, and I will tell you the reason for it. And I think it happened earlier than 1960, but more World War II oriented. But
and just to be for our listeners, so this next opportunity to take advantage of this pattern so 2021 is going to be the post-election year, right? And then 2022, so you're talking Q4 2022 is a buying opportunity.
I would even venture to tell you probably buying in Q2, Q3 and being in and prepared for the Q4 midterm year move would be more appropriate.
For the next 12 months, basically.
Yeah, or buying in October. And you might want to overlay the best 6 months with that and wait for our MACD signal.
All right,
which would be a combination of the 4-year cycle and the best and worst 6 months, or sell May and go away and come on back on St. Leger's Day, for those of you that don't know the full British
I didn't know the full one. That's great. Okay.
So I will get more into that St. Leger's Day stuff in a second, but let's just take another quick look at one of the more impressive four-year cycle patterns. The move, which is sort of right in that sweet spot wheelhouse there that I just showed you. The move from the midterm low to the pre-election year high used to be about 50% on average for the Dow. Now it's about 47%, which is on the table on the right side. NASDAQ, which of course only since 71 is a much shorter history, but still averages an amazing 70% from the midterm low to the pre-election year high. You can see last year and up 45.7%. And I've highlighted here October's and January's, which seem to be the most prevalent location of the midterm lows. October, again, that month, October phobia, where we have the mutual fund deadline for transactions to make distributions by year end, which I think is a big thing there. Also, the way it sits at the beginning of the fourth quarter, which is a whole different ballgame, as people tend to jockey their position and do some window dressing and portfolio restructuring in the fourth quarter for their statements that go out at the end of the year, as well as being after the very volatile end of the third quarter, September, back to school, back to work month. So there's a little, confluence of events that happens there. And then amazingly, on the right side of both these tables, highlighted in green, is these December highs. I mean, most the big cluster of highs is in December, and so many of them near the end of the year, the last trading day. Even the 2019, it was like the fourth last trading day for NASDAQ, third last trading day.
Wow.
For Dow. So this is it completely dovetails with the sweet spot. It's all part of that.
Stunning.
But it's amazing that we've had this big move, and that's the real importance of the four-year cycle and where you want to be, most invested in stocks.
Yep. Wow.
So let's look at just one little thing. I know this is a bunch of numbers and words. I don't expect people to read this, but if you get the slides, you'll be able to look at it. This is for right out of the page in the almanac, that we've only had one loser in the Dow in pre-election years in 80 years, since 1939, when German tanks rolled into Poland, right? And we had the Dow down 2.9%, even though there's a 23% gain from April to December. The next time we had the Dow down was 2015, with that sort of mild bear market that ended in February 16. That was an official Ned Davis bear market low. Yes, the S&P was off a fraction in 11, and NAS was off 1.8%, but the only one Dow loss in 80 years in the pre-election year. Again, showing you the power of the re-election and the election cycle.
So we're getting a few questions, Jeff, about kind of, is there anything different about politics today and the sort of the politicians of today and the animosity of today that's changing these patterns, or it's business as usual?
I think it's impacted the election year more than anything. The pre-election year, the third year, seems to be able to hold its strength, but that animosity and I think the constant campaigning for the full 4 years, and there used to be a bigger deal around the conventions, but now we have the whole presidential election campaign going on. I mean, when did we start with the whole Republican ticket? There was like 20 of them on stage back in 2015, even like a whole year before the election. Right. So yeah, there's a lot of animosity. There's a lot of that 24/7 news flow that there needs to be something to talk about, even if there's not. That's part of it. A lot of
criticism of the other side, and a lot of ginning up worry and fear and trying to drive out your base, right?
Yeah, and a lot of CYA, where people aren't willing to really go out on a limb and be a statesman and presidential and not necessarily listen to polls, but do the right thing. I'm not sure we're going to get that. I've been looking for something like that as a citizen, as a person, for years. I mean, it would be great to have W back, considering what we're looking at here. I mean, Bill Clinton was an imperfect character, but like Reagan before him, was able to work with the other side of the aisle with Newt Gingrich, even after during their animosity, and get some things done and come to some compromises. So I think people are right. Things are changing a little bit. I see it impacting the election year and maybe the post-election year as well. Again, we want to wait and see how the cycle happens. But the third year seems to still have its strength in with the priming of the pump for the party to stay in power. So good thinking. So this is the chart that's in the 2020 almanac. This was why my outlook was more bullish going into the year with the sitting president running. Everything was looking pretty rosy and pretty bullish and healthy for the economy until we had this lockdown and this quarantine. And you can see here that when there's an open field where there's nobody running for re-election, the market's kind of negative about 1.5% or so. And excuse me, when there's a sitting president running, 10.1% for the Dow.
So these are, just to be clear with everybody, this is the average performance in all of the election years from 1949 to 2018.
Yeah, the black line is all of the election years. This is the seasonal pattern. This is an amalgamation, a composite chart of all those election years.
Yep.
And the red line is those election years with just a sitting president running for re-election, which would include the current president in that description, and then an open field like we had in 2016, where there was nobody in office who was sitting in the presidency running for re-election.
Got it.
And then the S&P version, which I added the current year to, and the scale here is tricky. So I've got the right scale for the current year because we were down, 35% or so, or 30% in the S&P. And you can see they don't quite line up everywhere, but I got the zeros to line up quickly. So S&P up a little bit more, about 12.5%, about 6 or so in the blue for all years, and still about minus 1.5% for open field. But 2020 started out looking like a typical sitting president, just looking at the trend, not necessarily the levels. Typical, sitting president running for re-election year, and then we had COVID. And now it's sort of tracking back into that. And I suspect after a little sideways action, which I'll show you in a seasonal chart, the worst 6 months, we'll probably have a positive year. But we're going to look out for what Sam Stovall has developed, which is a presidential predictor. So it goes from July 31st to, and this is mentioned in our election year perspectives page in the almanac. If the S&P is down from July 31st close to October 31st close, president doesn't get reelected as much. I'm going to look it up here and read it for you if you don't mind. Let's see, Stovall's. 11 of the 13 years, the S&P was up over that time. The president is reelected, and there's a shift when there's a loss 7 of 8 years. So about 88% of the time, the direction of the market from July 31st to October 31st will tell you who's going to win the White House. And that's important because if you can understand that when October 31st comes around and you are getting a reading as to whether the president's more likely to be reelected or not, you can see what happens in years when presidents are reelected. So you can go back just there it is right there. Oh, I think I'll show you that here. So here's that particular, this is just a little list from that page. So you can see the different pages we have in the almanac that covers all the different important cycles and patterns for election years. And then here you see if the president is ousted and the market's down, you get a bigger rebound. I call it the ding dong, the witch is dead effect with an unpopular president getting ousted.
Yep.
I'm glad you find that amusing. I'm not sure that goes over well with everybody. And again, if you see the market being up, you might, who knows, you might have a little short trade or take a little off the table and come back in there after the market settles. Selling the news situation when the president wins re-election. So that's kind of how you want to game this presidential predictor market stuff. Is looking forward to with what happens.
Another question that came in was, have you looked at the influence of the FANG stocks and how they're really driving a lot of the gains? Is that?
Yeah, that's why we look at NASDAQ a lot. And that's why we have those particular, we're looking at we've added NASDAQ into our mutual fund that we run as, we go a third in the Dow, S&P, and NASDAQ because it's so influential. It's like the Dow, it's like the Nifty 50. So when you see these seasonal moves, whether they be monthly or otherwise, it's going to be apparent and manifested in those most popular stocks and the FANG stocks. Luckily, most of them, or at least the big ones that drive most of the QQQ, they're in the S&P as well. So they're already being, brought into the fray of the big blue chip indexes as they become the companies and technologies that run the world. So definitely important. And NASDAQ is covered quite a lot in the almanac, and we have a best 8 months for NASDAQ, which I'll show you a little bit because it's the thing that we stayed in there, and our best 8 months trade for the QQQs did a lot better than the best 6 months trades for the diamonds and spiders. So definitely an important place to have capital and to track the market.
Very good.
Just a couple more things on the election years, and we'll get into the seasonals. See, we got some time left here.
Minutes left.
Yeah, I want to leave a little time for more questions, but we've been getting some there. I want to show you some of the things that we put out in the newsletter as well. So just a reminder that the last 7 months of election year is pretty strong. That's June, July, through the end of the year. Only 2 losses. In the last 7 months, going back to 1952, 2000, we know what happened there. That was the undecided election. 2008, again, we had a major financial crisis and a recession that drove the market down. So otherwise, we've seen the last 7 months of election years pretty positive, and on average, only about 5%, but there's a few big years in there. So again, if we get some positives coming out of the, medical arena here with the pandemic and some other things, I think we can have a decent end of year, but I'm concerned about the next several months. And let's get right into that. So here is the pattern I think you were sort of referencing that Larry mentioned. It used to be more buy in May, and we see the flip happening. And I use 1949 because that's the end of that right here. That's the end of, there was a bear market, that post-World War II bear market that ended in 49. So we kind of started 1950 there for that. In some of the 4-year stuff, I'll start with 849 because it's the first full 4-year cycle after World War II. But you can see here, the economy and market was driven by agriculture. Most, about 30% of the country was farming. I think it was even 37% was farming in the first half of the last century, whereas now less than 2% are involved in the agricultural industry. And you can see as the spring kicks in with the hiring of new people, buying equipment, fuel, feed, and seed and fertilizer, and running the fields and taking care of all the agriculture. It kind of runs buy in May all the way through harvest time in September. But since 50 since World War II, you see the impacts of what Eisenhower called the military-industrial complex, and of course the information revolution that we've subsequently had, and the service economy that we now live in, where it's pretty much sell in May and go away. But that doesn't mean that the market goes directly down in May and is down only in May. There used to be something we called the May-June disaster area, which has returned again. But you see the sideways pattern where the market is prone to bouncing around and not making any gains from May through October. Mm-hmm. And I've got here in 1950 to the end of 2019, and also 1988. And I start there because it's post the 87 crash, which is where we had a major change to the inner workings of the stock market. The circuit breakers and the collars were put in, and it was a big systemic change to the stock market. So we also like to compare several different time frames and for these seasonalities. And we'll look at something that's 20, 21 years. I like to use an odd number so you don't get any 50%, basically, that sort of sit up and down, half and half, and we'll go back to when NASDAQ started, or we'll look at 31 years and go back to 1950 or 49. So you can see that a little more amplitude in the since 88, less periods there, but still the basic sideways pattern. End of Q2, where we are right now, looking at a potentially bearish situation here. I know today was up or is up sort of substantially. But that doesn't mean that we're not going to get a little further selling towards the end of this week, after triple witching is notoriously weak. Then first half of July, pretty strong. First beginning April week. And then we get this end of Q3 sell-off. So this is the kind of pattern we're tracking. And this is the discovery of what Yale invented in 1986, the best and worst 6-month switching strategy. And then let's look at it here, just a little cumulative numbers. On average, the November to April timeframe, that's end of October to end of April, up 7.5% for the Dow versus 0.6 for May through October. Taking a hypothetical $10,000 investment, excuse me, in the best months gives you a gain of over $1 million. In the worst months, May through October, a gain of $1,400. And then using MACD, which here we're layering technical analysis and a timing indicator on top of seasonality, increases that average gain in the best months to 9.1, turns the worst months to a little loss of -0.8, and nearly triples the results with the power of compounding to up to almost $3 million gain since 1950 in the best months.
That is crazy.
And, say again?
That is crazy.
Yeah, this is the big thing here. And then the worst 6 months turns into a bit of a loss. It's even better for NASDAQ, which I know some of our subscribers pretty much just take the QQQs in their IRA and use our 2 signals a year and get in and out of that and have done very well. And
you're still trading this in an actual fund today?
This particular thing is mixed into the fund. We have the fund trades more on the monthly and daily. Like there's a few days that are notoriously down here at the end of June that we're short for those. Mm-hmm. So it's a little bit more nuanced in the fund, but this is something that our subscribers that we do in the newsletter, mm-hmm. Which is we give these buy and sell signals. And I know I have testimonials from subscribers that are just, thank you. Everyone's complaining, but I just stick to the system and it delivers every year, even this year for the NASDAQ one. I'll show you what happens when we've got, a down best 6 months for the Dow, but it still works for NASDAQ. And then, since we had a really strong worst 6 months after the 09 low, I wanted to just keep a tabular track of the best and worst 6 months and best 8 and worst 4 months for NASDAQ since the 09 low using our MACD signals. And you can see that, yeah, there's been a loss this year in the worst 6 months. Not a great sign for the market historically. There's been a couple of weaker ones. There's been some halfway decent or even rather decent worst 6 months. But overall, on average, Dow and S&P up about 8.5%. And best months and only up about 2.2 or 3% in the worst months. And our sell signal was May 13th. it is what it is. We start looking for a MACD trigger after April 1, which is the last month of the best months, and then June 1 for NASDAQ, which is the last month of the best 8 months for NASDAQ. And we had a 17.8% gain in that trade. So this is one of the things we'll hold without a stop because it's a system. Some of our other sector ETFs, and this is the newsletter-based stuff, and our stocks, we will definitely have stops in there. So couple of things that we're looking at right now. This is the January barometer, another one of the cycle patterns that we're famous for. As the January goes for the S&P, so goes the year. It's not perfect, but it's still got about 75% accuracy ratio. And then there's this December low indicator, which was brought to our attention by Jeff Salt, who used to be with Raymond James. Now he's out his own, I forget the name of their firm out there. And it's if the Dow, somebody else is sharing the screen. Hello?
Yep, hold on just a second, Jeff.
Okay.
Where Peter's joining, he's going to be.
Hello.
Hi, Peter. We're still finishing up Jeff's talk, and so just sit tight, and we'll pick up with you in about 10 minutes or so.
Okay, that sounds fine. So I guess I have 3 things here: join audio, share screen, invite others. I guess I'm going to share screen, right?
No, don't. Perfect.
Okay, December low indicator. The Dow closes below its December closing low in the first quarter of the next year. Not a great sign. Here we've got another one of these composite seasonal charts with the NASDAQ in green, S&P in red, and the Dow in blue. The dotted lines of the current year updated through last Friday. Again, 2 different scales. Right side is the current year because it's so much deeper on the downside. But again, tracking this pattern pretty closely with a down January and a December low crossing. And here we are. NASDAQ looks like it's a bit ahead of its schedule. I think it's up a little bit higher today. But basically, still looking for a worse 6 month that's got some sideways potential retest of the lows. I don't expect we'll get anywhere near the low here. And I think that's going to hold. But again, depicting a potential sideways choppy pattern going forward once we get into the deeper into the summer months. Some of the stuff we're looking at right now, basically down best 6 months, except for 09 and 1982, where the secular bear market bottomed. We've seen not great performance in the following worst 6 months after a down best 6 months. Another quick thing I want to show you here, I know we're going to have a whole lot of time here, is this waterfall decline, something Yale came up with a while back. Usually takes about, 6 or 8 months or thereabouts to get back to that waterfall level after these steep declines of about 12 to 25 or so percent over. Say again?
Like what we just saw in March?
Precisely. So the thing about what we just saw in March here, it looks like a lot of things in many ways, but one of the things that stands out to me is the 87 crash, which was also down over 30% in a very short period of time. And it took a long time for it to rebound, almost 2 years, 21 and almost 22 months. So it's not like it's going to take that long, but it may take a little bit longer than some of these other periods for the Dow to reclaim its high. It's gotten up there quite a bit. We're up about 48% since that low for the Dow. NASDAQ set new highs. Again, it's not the same kind of thing that was a systemic market correction. This was a pandemic market correction. Thank God those rhyme. But just another look at one of the other things to keep in mind. We think the low is in. You can see here in the blue, this is right from the Fred database, great resource for people, fred.stlouisfed.org, great charting system. The recession bars and the market lows correlating very well with the spike high in jobless claims. And we couldn't put the current jobless claims on there because they were off the charts literally. So I got them here on this chart. Notice we've got a new recession bar already claimed on here. Spike high, the blue line in jobless claims, low recession bar. This recession bar may come out a little bit longer. We'll see how that ends up panning out. But one of the reasons we think that low is in. So I don't have a whole lot of time left, about 10 minutes or so. Want to give you a couple. Here's a little tactical chart for you. A lot of lines. I know some technical guys will give me some flack for having so many lines in here, but I see what I see. And these horizontal lines have been drawn on here for quite some time. The December low of 2018, the February 2018 lows, which are not on this chart, which is where we found support here. 27.25, an important level for me, where we had support holding in June of last year, where the 50-day moving average turned this year. A little support held at 28.15, which is where we failed to recover from the 2018 high. A couple of other little support lines in here. 29.55 was where we were blowing through there. 30.10 was the level of the the highs of last year in the summer of 2019, a level here. And 31.15 is where we're sort of dabbling right now. I think we were about 31.38 or something when I last looked before we logged on. But this is where this excuse me, big uptrend line from the 2018 low intersects with the waterfall decline right at this level here. And I think that's an important level for us. Then we've got this initial January low when we first started with the first big pandemic sell-off at the end of January, which turned a January barometer negative, 32.10 level, which we sort of failed at here recently. We'll probably be retesting that. Again, this is S&P and some of the technical levels I'm tracking here. That's a Trade Navigator chart for those of you that might want to know. And I forgot to mention back there that sentiment had got pretty frothy there. So some of the things we do in May, we don't sell in May. We reposition through May to July. We get out of our Dow and S&P positions. We just had our sell signal June 11th. The NASDAQ and the Russells. We picked up some bonds for the worst 6 months. We're into our top worst 6 month sectors. We tightened up our stop losses on our stocks, and we put out or got back into some of our defensives that got stopped out. So I'll give you a quick look at some of those things. Here's our tactical seasonal switching strategy portfolio. This was updated on June 3rd in the newsletter. Subsequently, we've gotten out of the QQQs for a decent gain. Russell's not so much. Added some more bonds for safety. Here's the sectors that we're in right now. Biotech is a sector for the future for us. It's one of the things I think is important right now. We're hearing a lot about biotech with this vaccine and testing and antibodies and treatments. Definitely the future for us, and some solid sectors that do well over the worst 6 months, and gold just being a holdover from last summer because it does well as a flight to safety. And we are of the belief that if it keeps going up, we don't necessarily sell it. We have stops on things. Yep. So key to investing, let your winners ride, sell your losers short is something we stick to. We did get stopped out of a bunch of things in our small cap portfolio. We also had a nice double in Regeneron, which is on this page, which we picked back in October using our stock screen, which I don't have time to get into, but it's a fundamental stock screen picked with stocks picked at the right seasonal time, as well as using technical analysis to pick the levels and get in and out of them. You can see we're up about 513. This was as of June 10th versus S&P 163 going back to July 2001. Some of our big winners, just to give you a little spiel, studying market history can produce gains like these and these. And these are ones that just sort of come through our screen. Arista Networks was a real sleeper pick of ours. It was a cloud computing success a few years back. And we trail our stops up, and when it stopped going up, we got out of it. Here's a look at the start date through the end of 2019 versus the Russell, which I think we're more comparative to, and the S&P. and all the kinds of things that you get with the newsletter. I don't have to get too deep into this, but one of the things I'm really proud of that we do, other than the analysis and the outlook and all that stuff, is that we actually give people not just what to buy, but when and at what price and what price to sell it at. So we got specific buys and sells and prices and limits and stops. So that's what you get. And the best 6 months buy and sell signals using MACD. And there's the codes for anyone who's interested. And if you got any questions, you can call me. You want the slides. And I think I was able to leave us a few minutes if you want to go back.
Yeah. So one of the things was, which MACD are you using to go along with the best and worst month strategy?
One of my favorite questions. Do you want to go back and do our videos and have our little chat?
Yeah, let's do that. So you want to stop sharing, and then I will turn my video.
Sure, I can do that.
You want to share a slide to answer that question, but yeah, you teased us with the MACD timing together with the best and worst months.
Well, I knew Jerry Appel, who we just lost back when I was a wee lad, and Marvin, who you might want to talk to at some point. His son and I are friendly. Okay. I know Marvin's using a couple of different MACDs, but we use the original ones that Jerry put out. And 817.9 is the buy one. These are all daily MACDs. So an 8-day, and a 17-day, and a 9-day exponential moving average. And everyone, you guys all know how MACD works, right? Exponentials. Excuse me. And then for the sell side is the one that most people are familiar with, is the 1226.9. And, tops are more of a process. Bottoms are more of an event. We've seen that V thing again right here, right now in 2020. And you want to be able to take your time getting out of a top and so you have a longer or slower MACD for that. And then you want to be getting in more quickly at market turnarounds, especially in October, the bear killer, the October 4-week month. So you want to get in with the faster and shorter time frame MACD. So 817.9 on the buy and 1226.9 on the sell. And you want to use MACD not in a vacuum. You want to use it to confirm a trade for another reason that you've analyzed it. For us, a lot of it is seasonal work. Some of it's a little technical, and if there's a stock we like, we might use MACD to get into it, but definitely use it as a confirm.
Yep. Well, that's great. I know, Jeff, that was a tremendous amount of information. I'm sure everybody's head is spinning, but it's all great stuff, and we've got it all recorded. It's going to be on the YouTube channel for the foundation. So shortly after this event, these videos will be available. People can study this, and we're going to be studying it. We actually want to take each of the presentations that the speaker's making and kind of take a week and unpack each one, because you just shared with us, a lifetime of what you've learned about the markets and what you learned from your father. And it's amazing to me that it's still working today, that as long as this stuff has been known, as long as you guys have been publishing it, it still works. And
there are shifts
in the pudding.
We have something called the indicator graveyard. There are a few that have been relegated to that.
Okay.
There's been some changes. We've seen some anticipators. Along the amazing line is the intraday stuff, which I didn't even get into. With all this HFT and algo trading, it's amazing that, on average, you see the market behave consistently throughout the day with these lulls around 230 and rallying the close. And I mean, it was one of the first things I learned to actually add up and calculate. So that's one of the amazing ones.
Take Jeff up on his offer. His newsletter is a bargain. I can tell you firsthand. If you have any interest in this material, it's absolutely worth having. Jeff, thank you so much for the time joining us. Let me just bring Peter in here. And I don't know if you guys know each other. Peter, are you there?
Yep, we sure do.
On camera now too.
Good to hear your dulcet tones there, Peter.
Yes, love listening.
Good to see you, Jeff. Nice presentation.
Thank you, sir. Good luck. Knock 'em dead.
Radio. All right. Thanks, Jeff. Bye-bye.
Ciao. Thanks.
Peter, can you turn on? There you are. Hello.
How you doing?
Good, thanks. How are you doing?
I'm doing fine, Richard.
Good. Well, thank you.
Glad to see things are going so well with the presentations.
Yeah, man, we're having a blast. And I mean, just great to have all of you legends to talk with, and you know, and to see even like in the Hirsch family, the sons picking up the torch and carrying it on. So that's awesome.
Absolutely. Listen, very few people have been in this business as long as I have, and I sure remember Jeff's dad. Yale was a great guy. In fact, he was very nice to me early in my career and gave me a very nice write-up in one of his stock traders almanacs. I think he used to do a thing, I don't know if they still do it, where each year he would talk about some technical person and you know, do some kind of descriptive thing on them. And I don't remember what year it was, but I remember very well that his dad Yale wrote a thing on me way back in the probably 70s or 80s. So it was very nice. I remember
And
that.
people won't be surprised by the sound of your voice to know that you were actually a piano player and singer early on in your career, right?
Did that for a long time. Yeah, music has always been my first love.
And you went to a reputable college, as I recall, right? And,
yeah, you know, I'm so disappointed in them lately, the ultra liberals, that I seldom mention it. I mean, almost everyone would be proud to say, "Gee, I went to Harvard," but
right.
now I see what
got a law degree, but couldn't stay away from the piano and singing, and then discovered cycles.
Yep, that's about the way it worked in a capsule form. Yeah.
I know I could listen to your stories all day long, you know, but we do want to cover some material for our viewers and everybody that's with us today. But you started in 1972 in the markets as a stockbroker?
Right around there, yeah. I don't remember the exact date. My newsletter started in 75, but I started my analysis and my study of cycles around 19.
The early TV shows, right? Like FNN?
Yeah. In fact, I started on the first financial television station in the country, which was KWHY, Channel 22, Los Angeles.
And from 1985 to 1990, you were ranked #1 market timing in the country by Mark Hulbert in the Hulbert Financial Digest.
Yeah, we got some good write-ups back in the old days.
And you're still on Neil Cavuto's show pretty regularly.
Neil's a good friend. I mean, he's been interviewing me for at least 25, 30 years now. So we know each other very well. If I have something important to say, I'll give him a buzz. But I tell him what happens when the last few years being overall quite bearish, that I come out of my bear cave in Dunlap, California. So I'm not close to any of the media stations anymore. So I do a lot less of the interviews. But when something's really important, I attempt to get in front of the public again.
Yeah, well, we appreciate it. And I know we're going to be getting into a different aspect of cycles. And, you know, your work, even though I've known about you for a while, your work was actually new to me. I hadn't studied the Hurst cycles that much. I wasn't familiar with these price projections aspects of cycles. So really looking forward to sharing that with the audience here today. And it's really interesting. And I've actually been following it on your app in TradeStation now and watching videos, and I'm learning a lot. So I do want to go ahead and get into it. I was going to say one thing, but I forgot. So it'll have to come back to me. So why don't you go ahead and share your screen, Peter?
I will do that.
And I'd like to turn off our videos while we're looking at the slides. So we just do the voice and the slides, and then we can come back on and kind of have a Q&A towards the end of the presentation. Okay. And when I remember what my question was, I'll bring it back up.
Can you see my screen?
Got it. You want to go into slideshow mode?
Sure do. Yep. We will do exactly that.
So from beginning over there on the left.
Yep.
Right there. Yep. All right. I'm going to turn on the camera, and but I will be here peppering you with questions throughout, I'm sure.
Great. Yeah. If there are any questions at all, please let me know, Richard.
All right. We'll do.
Okay. I set up this animation, maybe 6 or 9 months ago. And as I told you when we spoke before, if a work is not my original work, I like to give attribution to the person who's responsible for it. Yeah. This is from an old book called The Art of Independent Investing. The author was Claude Cleeton, Cleeton. And he's the one from whom I got the idea to do this sine wave animation. If we look at this chart, it looks like a typical stock chart. You can see the formations that happen on a typical stock chart. Here's a support line, once and twice hit and then broken. And as to be expected, when it's broken, we have the big decline, a follow through the downside. And then we have the trend line coming down. It's 1, 2, 3, 4 hits on that trend line. And we break above it. Again, as expected, a technical expectation, we start to rally. And then we have a triangle formation. So we have 2 tops here, a couple of bottoms here, actually 3 tops here, a short term, a couple of bottoms, and then we break out in a big way. And as you'd expect, after a triangle formation, break out to the upside, a big move to the upside. So the typical person might say, well, I mean, is that IBM or is that the Dow or what is that typical stock chart you're talking about?
It's a classic.
Well, pardon?
It looks like a classic.
Yeah, it really does. It really does. It could be virtually any stock. So let me show exactly what it is. Okay. I'm going to show you an animation here where you can see going sideways in time. If you look at the bottom of the screen, you'll see 1, 2, 3, 4, 5, 6 formulas. Actually, 5 formulas and one that says the sum of them all. So let's show the first one here. This is what you might call the longer of the cycles that we're looking at. Okay. So you can call this whatever you want. This is, by the way, as most people know, completely hypothetical. The market doesn't work exactly this way. I'm just trying to show people what a combination of cycles can look like. So let's call this the longer cycle. And now let's look at the next longer cycle in time, this little orange line. And you can see there are 1, 2, 3, almost 4 bottoms. For the big cycle, there's only 1 bottom. If we look at the next longer cycle, this is the one that's y equals 2 sine 6x for those that are mathematically oriented. And the shortest cycle of all, which is y equals sine 24x, you'll see. Okay, so this is a combination of 4 different cycles. And let me point a couple of things out here. Well, first, here's what I want to say about a combination of cycles, or the technical side of the market, and fundamentals. Those of us that believe in cycles would be fools if we said fundamentals have nothing to do with which way the market goes, whether it be an individual stock, the stock indexes themselves. Obviously, fundamentals are strongly involved. But the argument from a cycle person is that those fundamentals move in a smooth fashion. They could be going sideways. They could be going strongly up, strongly down, varying degrees of up and down. So it's only fair that we add what we might call a fundamental line to this chart. And there it is. In this case, we're saying there's a nice fundamental move to the upside. As far as I'm concerned, and most cycle people are concerned, these fundamentals have absolutely nothing to do with market timing, except for the fact that if you buy down here and are patient and hold up here, you're probably going to make some money if you're right about the fundamentals. But here's the important thing. If you add all these cycles together, where are they at any point in time? Right here, here's the long-term cycle top, the long-term cycle bottom. What do the combination of all these cycles add up to? And guess what, Richard? It's exactly the first chart we looked at. All the first chart is a combination of 4 pure cycles, a straight fundamental line put together, and they result in that chart that we showed that had all the markings of a typical technical stock formations: triangles, trend lines, support lines. That's what this green line is.
I love this animation, Peter. I hope that you'll donate it to the foundation, frankly.
Absolutely. I'd be happy to do that.
It really tells the whole story. So
yeah, it's sometimes difficult for people to picture. I don't know what you guys are talking about. For example, look at the bottom of the long cycle right here. Okay. Well,
Yeah.
people that look at that will say, well, that's a great time to buy the bottom of the long cycle. Well, not necessarily. You have to look at the rest of the market, because look what's happening up here. These cycles, one of them here, this second longer one, is reaching a top at the same time this was reaching a bottom. So the bottom in stock prices actually occurred down here, where three of the shorter cycles bottomed. There was still a downside influence from the longer cycle, but the bottom had already occurred. And once they started moving in synchrony to the upside, right here, when we have 1, 2, 3 of the longer cycles moving together, then you get a move like this.
That's when they all kind of come together and you really get the thrust up from all the cycles. What I love about it is it just tells the story so beautifully that markets are a combination of fundamentals and cycles.
Yeah,
you know, the
absolutely.
cycles. I mean, nobody argues that there's not cycles in our world, that humans aren't cyclical, right? That we don't have, as Jeff Hirsch was just showing, presidential cycles and quarterly reporting cycles and window dressing cycles and business cycles, economic cycles, psychological cycles. All these are at work in the markets together with some fundamentals, and you get the waves and you get the direction. And that's the story.
You know, there are two people you should talk to, two groups of people you should talk to about cycles. Okay. One of them is people like entertainers like myself that watch the behavior of people every night, as I worked in nightclubs playing and singing the piano. And we used to talk about full moons. And the other group of people, I think, that would go along with the lunacy that occurs during full moons are hospitals. So if you talk to entertainers and medical people, they will confirm for you that there's a definite lunar cycle when it comes to behavior of people in general. It's interesting. It's fascinating.
Documented and correlated to the stock market too. So
yeah, absolutely.
One of those cycles. And if it affects the tides, why wouldn't it affect us?
You know? Yeah, well, duh, you know. Can people see that? Okay, so now you've seen these individual cycles, how they form stock price movement in theory. Now what I want to show you is how the Hurst cycles come together and allow you to make projections in the market. So let's go to the next slide. This is an idealized 20-week cycle. It could have been one of the cycles we just looked at. So what Hurst discovered was, if you have a 20-week cycle, then the half span of that 20-week cycle would be 10 weeks. So if you move that half span forward, this cycle right here moved forward 10 weeks. So the high would be 10 weeks forward and the low would be moved 10 weeks forward. What happens is very interesting. The real-time prices go above and below the offset at exactly the halfway mark. So here's a cycle, goes down to -2, excuse me, and it starts moving up, and they cross right around the 0 mark. And if you measure that halfway from the -2 to the 0, that means you're 2 away. And so you come up to almost the 2 mark here, which is the exact. So in other words, what you look for is a crossing of the offset and call that the halfway mark. Then you measure from the low to the crossing of the offset and add that amount again to the cross, and that takes you to the next high. Now, mind you, it's the high for that cycle. It doesn't necessarily mean it's going to be an important high, because as we saw from the combination of the cycles, there were other ones that we have to pay attention to. But we can analyze each cycle individually. The same thing happens on the way up. So as we go on the way up, so in other words, coming down, this is the halfway point. It measures the full move. Coming up, this is the halfway point. So we can get downside and upside projections. So the next chart just does a simplified and obviously idealized cycle chart, an idealized bar chart with 10-week offset for a nominal 20-week cycle. And as many people say, what do you mean by nominal 20-week cycle? Nominal is a word that Hurst gave to the naming of the cycles, because he said these basic cycles exist in the stock market, but they're not always exactly 20 weeks or 40 weeks or 78 to 80 weeks. We call them nominal because it's just a name given to that cycle for an approximation of where most stock market or any market entities have those particular cycles. Almost all of them do, in different forms.
Nominal literally just means name, right?
Yeah, exactly. It's
The name
exactly
is
what
the
it means.
cycle.
That's exactly it, Richard. So notice here, I mean, this is obviously very simplified, but there was intraday high of 21 on this stock, and it met, to the downside, it met this offset exactly at 15. So you measure that 6 points down and you say, okay, it crossed the offset at 15. That's 6 points down from the high. Let's add another 6 points to see where this particular cycle should bottom. And sure enough, if you do the measurement, you come down and it hits a bottom of 9 right here. And then the same process all over again. Hits the halfway mark. Whoops. Why did that happen? Did you lose my screen?
Yeah, I lost your screen. It looked like you jumped to the end of the slideshow.
Yeah, let's see if we can bring
Hit
it
a
up
button by
quickly.
mistake.
No, I think I just hit the side of the chart. I can close this window, hopefully, right? Can you see my screen? Initially, when he started doing his cycle analysis, used offset moving averages. So for a 10-week cycle, let's say, he would do a 5-week moving average and offset it 5 weeks, because in theory, of course, a 10-week moving average, in order to represent where the average is 5 weeks back in time. So I don't want to go into this part of it in any length because it doesn't relate to what we're doing today. But I just wanted to show you how his work progressed from doing offset moving averages to when he moved to what I believe it was called the Cycle Sciences Foundation in San Francisco. He first started to do the market offset things. So you wouldn't, the problem with the offset moving averages is you would have to guess where they were going to cross the real-time market action because they were offset backwards in time. And so you would have to guess how that moving average would unfold in the future. What he went on to discover after that was that you could really move these averages or periods forward in time, and they would start to give you cycle projections. So what I'm going to try and do here, Richard, is go back to, here's the Christmas low in 2018, right back here. Okay.
Yep. Got it.
I'm going to start with, by the way, let me give credit for this fabulous software to Stefan Scheuermann, a German fellow who I met when he lived in Switzerland. And he now lives in Bulgaria with his girlfriend. But anyway, he was introduced to me by Larry Williams, who I understand did a great presentation yesterday.
That was fantastic.
So I can't tell you, I've been looking for literally a couple of decades for someone who could do these offsets correctly for me. And Larry introduced me to Stefan about a year and a half ago, maybe a little longer than that. And he and I have been working intensely for a year and a half to come up with what I wanted to do with the software. And he finally was able to do it. But the problem involved, I mean, it looks like an easy process. You just do the market and move it forward in time and see where they cross, and you have your projection. But I was more exacting than that. I converted Hurst's calendar day charts to market day charts. So, of course, if it was a 10 calendar day period, you want to know how many trading days that would entail. And in order to do that, you had to convert because you had Saturdays and Sundays and market holidays and whatever. So I started going through that whole process of saying, okay, let me convert this whole thing to trading days rather than calendar days, because that's what Hurst started out with originally.
And
so now,
if I kind of can sum up, some of the things that I've gleaned from your work for the audience, which is one that, Hurst had these nominal cycles he had certain cycle links that he believed were operating in all markets and all stocks, right?
Right.
And those are the nominal cycle links, like the 20-week, the 40-week. He wasn't doing just kind of a Fourier type of detection.
That's correct.
The most statistically significant cycle. He said, no, these are the cycles, and they vary. You might get 19 weeks or 21 weeks, but basically it's a 20-week cycle. We're going to name it the 20-week, and we're going to look for it in all markets and all assets, right?
That's correct. Exactly.
And there's a set of cycles that are kind of the Hurst cycle lengths that are fixed.
That's correct.
And he did it in calendar days, but you converted it to trading days, so they're a little different. So
they are different. So it's confusing to people, because if I say in order to measure a nominal 20-day cycle, you use a 7 to 8 day offset. And people say, what? Right. 7 to 8 days is the half span of 20 days? I say, yes, because it's a nominal 20 calendar day cycle.
And to me, these offsets are what you're really doing is you're saying, well, where is price at when you're halfway into the cycle?
That's correct. That just like the idealized chart we showed you. Wherever it crosses, wherever the offsets are crossed by the real-time prices in the market is the halfway mark. If you've placed your offsets correctly, that's the halfway mark for that cycle.
Yeah, and that's really interesting because people, like Larry Williams said, you can't, you never know the magnitude of a cycle. Amplitude doesn't tell you how big a cycle is going to be, right? But in a way, this is kind of telling you the magnitude of a cycle by where is price at halfway into the cycle, and it's likely to go twice as far as that before this cycle ends.
Right? And the important thing about what you just said, and you're exactly right, is that there's no theory behind what the magnitude should be or how far would it move within a 20-week or 20-day cycle. We let the market do the talking. You look at market prices and they tell you what the magnitude is within that particular cycle. Sometimes a 20-week cycle will not produce anywhere near the type of move that produced 6 months or a year ago, because you're within a different overall aspect of all the cycles. So what we do when we measure is we look at real-time prices, and they tell us in real time what is the strength behind a nominal 10-day cycle? What's the strength behind a nominal 20-day cycle?
Yep.
So with that kind of background, let me kind of show you what we do. And this is the way my little boy genius, Stefan, set up this program. I'm going to right click on this offset, and you can see that this is a long offset. This is 96.8 to 110.6. If I were running a class where I were quizzing people now, I'd say to them, okay, what's that offset? What's 96.8 to 110.6? How many weeks is that? And the answer is 20 weeks, of course, because if there were no market holidays or Saturdays and Sundays, but first of all, let's say if there's no market holidays, 20 times 5 trading days in a week would be 100. So in order to do a 20-week offset, you just move it over 100 days and that would be it. But there are trading days and there are holidays, And that's why these numbers are different from what the simplistic ones would seem to be. But let's start back at some of the shorter cycles. Let's go back to this bottom and let's start with let's go to the second shortest offset, okay? So we click that and immediately the program goes to a 3.5 to 4 day offset. That's what these two lines are. Now, another thing that happens is, notice there are two offsets for almost all the daily projections. And sometimes they're unclear. The thing that Stefan did that no one else was able to do for me was he did fractional offsets. Everyone told me prior to Stefan, no, you can't do that. You can't do it with Windows. It doesn't allow you to do fractional moving averages or offsets. And Stefan said, yeah, I think I can do that. And he did. Now, it looks a little messy here because the red line, which has little tails on it, you'll notice, that's the 3.5 one. So in order to clarify that and make it look prettier, he allowed us to do what he calls a web chart. And on the web chart, we don't have any of those ugly little tails and things. It looks like this. Okay. Now, here's the other thing. I conceived of a continuum. And what I mean by continuum is at any point in time, what is the difference between the 3.5 to 4 day offset? And as you can see, the differential grows larger and smaller over time. This gray area is the difference between the 3.5 to 4 day offset. And when we get a projection, we want to know where the blue line, which is the midpoint for each day. This is something that Hurst started. Hurst did not look at closing prices. He looked at the high and low for the day and took what he called the median or midpoint of the high and low to measure the movement. So if there were a huge high and a huge low, you would just take the midpoint each day to measure the representation of the price that particular day. Okay. So now let's remember the idealized chart that we looked at. Prices start to move up. This is December, the Christmas low of 2018. They start to move up. And on this day right here, we get across above the continuum. We have a projection. Okay. Mm-hmm. And here's the projection. It's going like to 2573.52 to 2587.46. Now, why the two numbers? Well, they're simply determined by taking the lowest place where the price crossed above the continuum to the highest place within the continuum where prices crossed. So that's why we have a range here. The lower projection is the lowest crossing. The higher part of the projection is the highest crossing. Okay.
Got it.
So now another thing you watch for is projections can be invalidated, as can almost anything else in life, as we know. So if the blue line goes below the continuum after giving an upside or a downside projection, in the case of a downside projection, it would go back above the continuum. But there are only two things that can happen once a projection is given. It'll be reached or it will be invalidated. So in this case, you can see 1, 2, 3 days after the projection was given, we came close to invalidating it. Got into just inside the continuum here. But the market came through, realized where it was supposed to go, and indeed up we went. Now, on this day, you say, okay, we reached the projection, so now we can go short, right? No, that's not how it works. Remember, when we looked at the idealization of all those cycles, we had some that were working to the upside, some that were shorter than others, and all we're doing now is looking at one of the very shortest cycles. So once we reach the projection for the shortest cycle, then we want to look at the next longer offset. So at this point, let's go back to our offset chart. Let's click on the offset. You can see what we used to have to enter these things. We'll go into the whole parameters thing and whatever. And Stefan simplified it so much, you can just go from one offset to another. So this 3.5 to 4 is phenomenal 10-day projections. That's what we just looked at. And remember where that projection was given to up here. It was given up to around 2573 to 87. Okay. So now we go to the next longer offset, which is 7 to 8 days. And we got up here, and now we have a slightly higher projection. Now look what happened down here. We came up, almost went through and gave here's the terminology I use, Richard. When you get above the first offset, I say a preliminary projection has been given. When you get above the second offset or below it on a downside projection, then I say the projection has been confirmed. So in this case, as you can see, in fact, let me zoom in on there so we can be a little more clear in terms of what we're talking about. So on this day right here, a preliminary projection was given. And if we were doing this in real time, the software would have registered that preliminary projection, okay? But then the next day, it looked like it might be called into question because we still remained above the first offset. The preliminary projection remained in effect, but it did not get confirmed until this day right here. So on this day, we got a confirmed nominal 20-day projection up to 2591, I'll round these off, to 2642, okay? So now you say, well, you met this projection, do you short here? No, you don't short there either. You wait. The ideal point to take a position, long or short, is when all projections have been met. And when they're met, no further projection has been given. So you'll note from this Christmas low, as we move our way up, as each projection is met, and we look at the next longer offset, we continue to get higher and higher projections. So this particular projection called for 2590 to 2641. So that was reached, let's mark this date, that was reached on January 17th of 2019. Keep that in mind, and let's go to the next longer offset. This is a 2.5 week offset, 12/1 to 13/8, for a nominal 5-week projection. So let's look in time. Okay, now here's our date, Jan 17th. Now we reached the projection, the nominal 20-day projection. But as we did that, several days before that, we got an even higher projection, 2752, 2780, rounded off, okay? Mm-hmm. So now we have to wait and continue and wait. Now here it looked like this, when you're analyzing in real time, you still have some decisions to make. I mean, look how close we got from this January 19th reading, which was way back here when we originally met this projection, and we got this higher projection at that time. Then we come up really close to the projection in this level here, but we hadn't reached the lower side of it yet. So you remain patient, and you know if prices go below both offsets that you have the possibility of an invalidation, and that is a different story. So here's what happens. We have this next longer projection, 2780 to 2752 to 2780. And then we reach that on February 13th. So here we go. We look at the next longer offset. I don't think anyone's getting bored yet, are they?
No, we're getting questions about, is this software available for sale?
Yeah, it sure is. We'll talk about that later. I hate to be a commercialized cycle punk, but yes,
no,
I'll definitely.
In business, and you're all talking for free, so
I'll definitely mention that. Yeah, it's if they go to stockmarketcycles.com/register, it's not only for free, but I do a daily YouTube update, as you know, and comment on the projections as they're given.
Yep.
It's now become a pay-for video. I did it on YouTube for nothing almost every day for 9 or 10 months.
Yeah.
And also software is now available on TradeStation if people have that. Within a few months, we hope to have it available on our website. But people can go to the website, stockmarketcycles.com/register, and they can get a 14-day trial of both the video, and we have a special bundle price for video and the software itself. But yeah, you can put this fabulous software in your hands. Believe me, if you're a market aficionado, you love the markets, as most all of us do that are talking now, you won't be able to sleep at night. You'll wake up in the middle of the night and say, wait a minute, I want to look at this offset. Wait a sec, I want to look at this stock, this index, whatever. It's just completely fascinating. So now let's keep following it forward, though. Now we have a 12-1 to 13-8 we looked at. Let's go into the next long one, the next longer one, because we reached that on this date of February 13th. So now we go to the next longer one. And what did it look like on February 13th? Well, here's February 13th. And look where the crossing took place, and look what the next projection is, all the way up here. So on February 13th, right here, as the next shorter projection was met, we still can't go short. I mean, you can do little scalping trades, but you still have higher projections, and you have to pay attention to them. But let me go back to the next shorter one again, because a nice thing happened on that one while you were waiting. Look at this. Wow. So you knew here that we still had higher projections, but this next shorter offset, the 12-1 to 13.8 nominal 5-week projections, gave a downside projection. Guess what happened?
It got filled.
Projection called for 26.86, rounded off to 27.24, and the low came down to 27.69. No, that was not it. Where's the low here? Right here. The low is 27.22, right inside the projection window. So while you're waiting with these higher projections, the next shorter one gave a downside, and it would have allowed you to catch this bottom. Okay, so now we go out to the 24.2 to 27.6. It's going to start getting really interesting now, because watch what happens here. Okay, so now we know we have to get up to at least 28.84, and we do that. Look at that, 28.85 high. So on this day, April 3rd, you just barely met the lower side of that projection. Okay. But we came and fully met it as we came up here, almost fully met it, because into May 1st, as you can see, we came up to a high of 29.54. So again, now this projection was exceeded. We're not going to go and look at all the other offsets now, because right now I want to follow the process of the upside projections. But I'm betting that this final low was given by another one of the offsets. See, people might look at this and say, well, that projection didn't work. You went down lower. And my answer is yes, it did work. But the moment you meet this projection, it worked. It doesn't tell you that's the final low, because you have to look at your other offsets to determine that or not. Okay. So now let's go to the next longer offset. This is a 10-week offset, 48.4 to 55.3. Okay. And this one's going to be interesting, because it's going to show you in more detail how the software works. Okay. I'm going to, again, let me go back to the left of the screen. Here is the Christmas low again, okay? So we got a crossing here, and it called for a projection up to 30.43 to 32.26, a lot higher than we were at the time of the projection, which was right around the 27.40 level. So we're talking about another 10% higher on this projection. But watch this, Richard. We started going up towards that projection level and came down. And as we came down, we went below the initial offset line and then below both offset lines right here. Now, to me, this is really exciting because it shows you there's almost an awareness on the part of the offsets what has to be done and what will happen if they invalidate projections, because this almost happened twice. You'll see that for 2 days here, maybe 3 days, prices remained well below the second offset line, in theory, invalidating this projection up here. And that's why this turned gray. But we have a tool with the software that can handle that, because my theory is that we crossed the offset here, then we had a little bit of a move down to it, and we crossed above it again here. So this, to me, is not a distinct crossing below. If it had come down into this area and stayed for a week or 2 or 3, that's a different story. Then you definitely have a confirmed invalidation of this projection and a generation of a new downside projection. Okay. So here's the way the software handles that. If you see something like that, you go to studies and you go to edit studies. And here are the parameters. This is the one that's on right here. We customize it. And I have what I call a nick filter. The nick deals with a number of days that prices just nick below the offsets and appears as if they will not remain there. And especially after these 2 days here, where it had the little nick for a day or two below, immediately moved back above again. So if I put in a nick filter of, I think 3 days will cover it, then the software will ignore. See, 3 was not enough. I guess it's down there. 1, 2, 3. Let's see if I were making a video now, I would edit the video to take out all this extra time. But I want people to see also how the software works and how it's been fabulously put together by Stefan to take care of these little exceptions to the rule. So we want to customize. Let's try a nick filter of 4 and see what happens. Yeah, it's still not doing it. And I got to do, I'm going to go out one more. If this doesn't work, I'm going to continue with the presentation, but no, okay. Anyway, the theory is that because we just did a little nick to the downside here and immediately move back up again, that this projection remains in effect. For me, it would remain in effect.
What Tom McClellan calls kind of simple and complex structures, below and above the
that would be definitely somewhat analogous, yes. So now, sure enough, even though you again had moves below here. And the other thing is you look at other indexes and averages too, Richard. If you look at the Dow, did the Dow do the same thing here? Or maybe it stayed above? Or look at one of the broader, like the Russell 2000, whatever. What are they doing here? You want to look at all the averages. But what I want to do now is maybe accelerate a little bit and go to this long offset here, okay? This is the pièce de résistance, because this offset, now maybe I got to take those nicks out of there. Edit studies, on, customize, take out this 5. There we go. Okay, so now way back here in March, April of 2019, that's only what, about 3 months after the bottom in December of 18, we got these projections. 31.58.63 to 33.31. And I hope everyone is noticing that the longer the cycles tend to be, the more impressive the projections. So, I mean, if you get a 20-point higher projection, you'll say, big deal. It will be a big deal if you're trading and trying to scalp prices, but this is a long-term projection, and it's telling you that this is a thing of beauty. Watch how this unfolds now. So this projection is calling for 3158.63 to 3331.11. Now that projection, the underside was just missed in here. In fact, I'm going to zoom in on there so we can get a real close picture of how this whole thing unfolded here. See this date back here at the left of the chart? The high that day was 3154.26, and the lower box of the projection called for 3155. Ultimately, we definitely got into it. This was in December of 19. We finally met this projection. Not only met it, but we continued up to the point where, watch this, if we extend this line over, look what happened on January 22nd of 20. We got to the very top end of the projection, and it's almost as if the prices knew it. And they said, okay, now we're exhausted. We reached all the projections outstanding, and that's the best we can do. So we had a nice little decline here, little ABC decline of several points in the S&P. But here's what I told people at the time. I said the only way to get higher projections now is to have what I call a loop projection, which would mean prices would come down. And if you look at the shorter offsets again, let's go to the shorter ones, they would cross back above in a loop to get higher projections. So watch what happens here now. Let's go to the 7 to 8. This is the nominal 20-day projection. This was the very top of the projection range. We came down, exactly hit this short-term projection, came down, tested it again, and here's where the little loop came in. Down and loop up. That's the only way we could get higher projections. And look at the higher projections that were given. 3382.22, 3406.64. What about the next longer projection? Because there are only so many loops that can be given. The other ones are too long. So here's the 12.1 to 13.8. Look at this. Exactly the same area. So I hate it when people say I did this and I did that, but I did do on this very day. I went 2x short with some of our friends and family accounts and some small managed funds. We went 2x short the S&P on this day right here. Didn't hold it all the way down, but held it down for like a 20% gain within about a week or two.
What was it that caused you to go short at that point?
Because at this point, we reached all possible upside projections. I said the only way to get higher ones would be to have a loop projection where we get down and get to the point where we can cross above the little loops that we just formed. So watch this. I'll go, okay, so here's the highest we could get. But if we get a move down and watch this offset, we can cross this offset to give us a higher projection than this. Mm-hmm. It would be with a shorter term cycle. You met all long-term cycle projections here. Remember when we showed the simulation of the 4 or 5 cycles, and sometimes when a long cycle was met, there are shorter term ones that provide extra impetus to the up or downside. In the case of the example we showed with the sine waves, it was to the downside. In this case, it's the upside. We met all long-term cycle projections right here. We turned around and through a little loop through the short-term cycles came up and not only met a nominal 10-day projection, we met the second one I showed you, nominal 20-day projection as well. So, excuse me, nominal 5-week as well.
You kind of step through all these different cycle lengths, right, until you've exhausted all of the upside projections.
Exactly. So at this point, Richard, there were no higher projections to get.
Yeah.
We could do another loop. You could come down here and then come up above a shorter offset again. But because this was a long-term meeting of projections here, and we did one loop, that was enough for me to say, okay, this could be an important top.
You think these only predicted COVID-19?
Well, I'm not
I mean,
going to go
that's
that
pretty
far.
amazing pattern there, right? Going all the way back to
I'm not going to go that far, but I think you and I both know that a lot of times the market does things that people will say, oh, come on, you couldn't possibly know that ahead of time. You say, well, no, I really didn't. But what I did was I looked at the technical side of the market. Let me show
Right.
one more thing here, and then we
I
can
want you
talk.
to get to current markets because I'm sure everybody wants to see where the projections are.
Oh, do I
today.
have to show current stuff, Richard?
Come on.
Okay, let me
I
show.
just want to like just summarize again. Like, so Hurst had these different cycle lengths, right?
Yep.
And they're fixed. You know, in the Hurst world, you're not looking for the cycle lengths. You already know what they are.
Nope, I don't know
Kind of
Fourier
separate.
analysis, no real time trying to
Right.
track the cycles. We have our somewhat fixed nominal cycles. Yes.
Right. With a little bit of wiggle room.
Yep.
And then you kind of, for a big trend, you just kind of step through each cycle length until it kind of completes. And it might take longer than the nominal cycle length, but overall, once it's kind of halfway, once it crosses its halfway point, you're projecting that higher, twice as higher into the future.
That's right. What I learned long ago, Richard, and I know some cycle people will disagree with me. Hurst also he used the timing factor. He used nominal 10-week and 20-week. And so this one should bottom here, that one should bottom there, perhaps a top here, a top there. To me, a long time ago, I learned on an experiential basis that I don't care about time. I care about it, but the greatest determining factor is the price itself.
Mm-hmm.
Before we talk about, and I will show the latest projections, but look at this. This is the high we just dealt with right here on February 19th.
Right.
Look at this projection. This is a 39-week offset for a nominal 78-week projection. In terms of trading days, it's 189 to 194 trading days. This was one of the first cycles I ever picked up on in the market, going back to the Hurst days and back in 1970s, 1980s. 189 is 9 months. So this is a 9-month offset, 189 to 194. And look at the projection that it gave coming into March. That's the downside projection.
But this is fascinating because it's like the cycle's in play, but it's not, it doesn't, it's fulfilling a lot more quickly in this case than what the length of the cycle would project.
That's exactly why I don't pay attention to time anymore.
Wow.
I want to see what kind of projections are being given. So, okay, let me give you some real-time projections. And my disclaimer is, don't anyone dare and go out calls and say, Eliades told us to go out and buy calls because we're going up to XYZ. And that's
Everybody
it.
on this call is mature enough to know not to do that, Peter.
I sure hope so.
We would never do that. We'd never just take somebody's word for it and not do this ourselves. We know better.
With that in mind, let me show you. There are 3 higher projections now. This is a 5-week offset that we're coming close to, nominal 10-week projection. Let's look at that first. So this one calls for, and remember, these are intraday, not closing prices, a minimum move up to 33.71. It looks like 56. The numbers are, in fact, let me zoom in on that so we can read these numbers more clearly. So it's 33.71.56 to 34.65. I think the important thing now is to look at the lower side of these 3 projections I'm going to give you, because they will determine the minimum upside that we should be expecting to see. So this is the 24.2, 27.6. The next one is 48.4. How many weeks is that? Anyone? Raise your hand. That's 10 weeks. Okay. So the 10-week offset, nominal 20-week projection. This one has a bigger window. Now, why does it have a bigger window? People might say, well, that's no good. You do bigger window there. That doesn't help me. The hell it doesn't. Of course it helps you if you're down here.
Yeah, I take the underside of that.
and the reason it's so big is look at the 2 crossings. The initial crossing took place here. In fact, this is better to see in Stefan's what he calls the web chart. Let's take a look at that.
It had a lot of volatility there, basically, that kind of expanded the range.
So if you look at Stefan's web chart, you can see within the continuum, you want to find the highest price and the lowest price that the blue line, the light blue line, the midpoint of every day would have crossed above. So you have this whole continuum here, and that's what determines how big this rectangle is. So let's look at the lower one here. But you can look at both of them, 3503, 3794 rounded off, okay?
Yep.
So now there's one more. The one that gave this downside projection, 189 to 194. No, wait a minute. We look at this. Oh no, that one has not been given. Okay, we want to go to 189 to 194. Oh, you know what happened? This is the, anyway, 30, is this 3546? 3465, 503, 349. Okay, without wasting any more time, let me tell you, there are 3 projections up into this time zone. The lowest end of all 3 projections I will give you. It's 3465, 3503, and 3490. All 3 are very close to each other. So I would say the minimum we should expect to see would be a new all-time high, and it would be 3465.
But we don't really know when that would likely happen, right? I mean, it could
No,
happen.
you don't. As a rough indication,
3 months.
again, this is only rough indication.
Yep.
I would measure, and again, this is just very crude. How long did it take to get from that low to this crossing? And just take that out the same amount of time.
Got it.
But again, I qualify it. It could happen in a week or 2. It could happen several months down the line down here.
With all kinds of questions, Peter, like, does this only apply to the S&P 500, or can you use it on anything?
Use it on anything. I've used it mostly with the S&P, but Stefan's working on, I've asked him to work on the reverse process. In other words, you would say to the computer, okay, here's a high, here's a low. Tell me exactly what offset would have given you this projection perfectly.
Yeah.
Okay.
I know we're coming up on the end of the hour, but I think we can continue on for a few minutes unless Lars tells me otherwise. But, you know, I think that's part of the prerogative of being the last speaker of the day. You get to go over a little bit. Lars says, no problem, we can go on. All right. Good.
Great.
Good. So, yeah, new all-time highs probably in the S&P 500 is what you're.
That's what the projections are telling us. You know,
it's what the projections say.
Now, let me show you one more thing, because I very seldom do individual stocks.
Okay.
But people ask me about them all the time. So back when I was doing the YouTube videos around March or April of this year, one of my favorite stocks, because I happen to own the second version of the car, I've had 2 Teslas, has been Tesla, which is a fabulous performer. I mean, if you wanted me to do a testimonial for why Tesla might increase tenfold over the next, despite the fact it's so high right now, because of they've got their fingers in so many things. But look at Tesla. Look at this downside projection at the March bottom. And by the way, it bottomed on March 18th, several days before the market. But around this time right here, when we crossed above the 5-week offset, we got an upside projection to a minimum of 919.34. So from here to there, I think it's like 35, 40% move to the upside. So yeah, does it work with stocks? I'm not promising people it will, or that will work with every stock. That's something we're working on. The software will be able to deal with that in the future. But I did want to show an example of a stock that not only worked giving a virtually perfect downside projection, but in real time. If people want to go back and look, my YouTube channel is is youtube.com/C for channel /stock market cycles. All my videos for the last 9 or 10 months are up there. Go to the video of April 23rd, which is this day right here. Okay. This is when I gave that projection.
Okay, great. And are there any other favorite assets that you use this on besides the S&P 500 that you think it works really well on?
You know, I'm sorry you asked that question, because the best one of all is the New York Composite Index. And for some strange reason, TradeStation, which is what I use for my data purveyor, no longer carries the New York Composite Index. I have said for years now, going back 20, 30 years, as long as I've been doing projections, that the New York Composite Index is the most consistently accurate projection generator. And now TradeStation has taken that away. So I cried a few tears on that one.
Wow. And is this what you were using back when you were winning the market timing report?
Yeah, I've been using
85 to 90.
I've been using the projections going back to mid to late 70s, early 80s. Yeah.
I can see why you love Stefan so much, from finally
no
realizing your programming dream.
But don't tell him that. You'll give him, I'm sure he's watching today, you'll give him a swelled head if you tell him that.
Well, anyway, this is really fascinating, Peter. Thank you so much for sharing this with us. Obviously, it's very compelling, but it really kind of bends my mind a little bit about what are cycles and how do they really work, Yeah. And so the fact that you're seeing, that you're kind of seeing a cycle being activated, and then it may fulfill its consequence in a shorter period of time or a longer period of time. You don't really care. It's active, and it's going to kind of exert its influence on the market, whatever is causing it. And it could happen sooner or later. It doesn't necessarily have to happen.
Yeah. Just give me the prices, which, one more quick thing. Be aware all times that the projection will be invalidated if you move below both projection lines. So don't sit like a little fool, watch prices go down here, which is not a huge decline, and say, oh, no, we've still got upside projections. No, if they get invalidated, and only two things can happen, they're either met or invalidated, but you have to watch for potential invalidations.
All right. Well, let's stop the screen share, just kind of turn our video back on, wrap up, say goodnight. I think, let's see. Do you have your video on? You can just start.
I will in a second. Right now, I have my video on. You cannot start your video because the host has stopped it.
I stopped it earlier. Try now.
Start my video. There we go.
I didn't want everybody to be distracted by your looks. All right. Anything else that you want to share with the audience just on your work with cycles over 50 years?
No, just, as long as I've been doing this, Richard, I never am ceased to be fascinated by it. And I have never ceased, I never cease to wonder at when you do this and you watch these things unfold, it's kind of hard to believe at times. I mean, if you go back to March 23rd and people had told you at that point that the NASDAQ would be at a new all-time high within a couple of months, you look at them and say, what, are you stir crazy? The whole world has stopped. We stopped everything in the world. There's no way we get back to new highs. And I would have said the same thing at the time. But within a few weeks going into April, then I knew that we started to get those higher and higher projections. And so you look in wonder and you say, it goes back to the original Hurst book. Don't pay any attention to fundamentals. They're not going to help you time the market.
Yeah. All right, Peter. Thank you so much. Great presentation, great information. And you've really, you've advanced Hurst's work quite a bit on your own. Kudos to you.
I appreciate that, Richard. It's always fun to talk with you.
Yeah, thank you. All right, we'll keep in touch, and we'll get back in front of the foundation audience sometime soon, I hope.
Great. Take care.
Right. Thank you, Peter.
By the way, you're doing a great job with the foundation. Keep that work up, because to all of us that work with cycles, it's very important. So we want to maintain that, the importance and the integrity of the foundation. And you've done a great job in bringing that back again. Congratulations.
Appreciate it. All right. Well, good night, everybody. Thanks again, Peter. Talk to you soon.
Take care.